Welcome back to In the Harbor, the podcast where sports, leisure, and finance meet. I'm your host, Jason Johns. Today, we are bringing back a former guest in Rich Consul. Now, Rich, you are our second repeat.
Oh, man.
You and John Buchagras now, so you're in good company.
There we go.
Although I suspect the conversation's going to go a little different than ours with Bucci's went. Little different subject matter.
Well, hopefully we can give you some good hot takes here.
Absolutely.
Yeah.
I think we'll definitely be able to get some hot takes.
Yeah.
In particular, there's a couple items I want to get to. But I think it's important just to refresh everyone's memory from the last time we had Rich on from Banker's Edge Advisory. Little background, longtime institutional money manager, multi-time PSN award winner. Over 2 decades of experience on connecting macro events to market implications across the fixed income, currency, and commodity markets. So those are all hot ticket items right now.
They are.
So,
Markets that are really good at humbling people who think they're smarter than them.
everyone thinks they're smarter than the market until they screw it up.
That's right.
So, you have a framework that's really this polycrisis environment we find ourselves in. So I think let's just kick it off and talk about that a little bit because we have a lot of noise in the background.
Yeah.
And how is that impacting markets? We're seeing kind of mixed signals.
Yeah. Well, let's kind of frame up what a polycrisis is. I think that's key, right? Because we have to think of it separate from multiple crisis or a multi-crisis. Okay, so what is a multi-crisis? Multi-crisis is a bunch of distinct crises happening concurrently with one another that really don't interact. Okay, what could that be? I'm having trouble paying my mortgage and my aunt dies, right? 2 distinct items. And they don't really kind of cross over.
Seemingly unrelated.
Seemingly unrelated, and I can handle each one kind of individually and separately. A polycrisis is where you have a bunch of different situations going on concurrently with one another that seemingly are distinct, but really start interacting and amplifying one another. I think right here, as we look at it, we're in the middle of a little bit of a polycrisis when we kind of look at the consternation between the Fed and the administration on right. Lowering rates, when we look at kind of where oil prices are spiking with this war in Iran, and then some of the kind of concerns that we were hearing last year from is the consumer stretched, right? Have we run out of steam from the consumer perspective? But there's just a whole host of different things that we can kind of pile on to that, private credit, you name it. And a lot of these are interacting with one another to create compounding effects, right? And in the markets, what we have to understand is we have to separate all that, right? We have to separate all those polycrises and get down to what is that signal and how do I trade it and how do I make money off of this? Because it can create a lot of noise.
Well, then I think you have to apply a weighting to them as well, because if it's, if you're thinking about in a vacuum, one crisis at a time, what does that mean for the market? Mm-hmm. But then you go to another crisis, and the market implications could be the exact opposite.
Yeah.
So kind of weighting how that's going to play out in the system.
Yeah, I mean, it's a great question. When I was a trader of FX back in the early 2000s, I lived in London, worked for one of the largest trading desks for Bank of America, and I helped manage their emerging market currency book. And what was really interesting about this situation is our managing director always used to say, the economy always gets down to 4 things. First quarter U.S. consumer, right? So keep in mind, you're overseas, right?
Right.
This is a Forex trader, and he brought it down to always these 4 things. Number 1, first quarter, how did tax returns come back for the consumer in the United States, and what does that actually mean for how they spend? Number 2, what did they do for spring break and summer preparations, going on holidays and what have you?
Right.
Summer was getting prepared to go back to school and back to school spending. And then number 4 was basically the holiday shopping. So he really broke down everything could be understood by understanding what influences the consumer almost on a quarterly basis and what are the biggest quarterly drivers of the U.S. consumer.
But this was an international perspective,
Yes.
Looking at the U.S. consumer as the
is the main driver.
Yep.
And I think that's what we see with like a lot of these trade negotiations, right? Why do we have so much leverage in these trade negotiations? Because it's us as consumers, U.S. consumers,
Right.
that really drive not just the United States economy, but because we're such a large export or importer, drives the world economy.
That's fascinating.
So that is like, so when we kind of think about these polycrisis, I always kind of go back to that original framework. How does it affect the U.S. consumer? Because in the end, if the U.S. consumer can keep chugging along, a lot of it's just noise.
Right. And that's, I mean, it does make sense just given the size
Yeah,
of the U.S. consumer base
yeah,
and its implications across all markets.
yes.
So,
We were out with a couple different people last night. NCAA tournaments going on. Great time to get out and
is that going on? I haven't noticed.
So a bunch of us were watching the game, and a couple institutional managers and what have you that I've worked with in the past, and we were sitting there talking about actually the great financial crisis, right? Because we were all in seats at the time trading. And I think one of the things that is often missed is everyone always looks at kind of that time and goes, oh, subprime mortgages, that really... No, it wasn't. Subprime mortgages is just one aspect of that polycrisis.
And there were some canaries in the coal mine well before that
Yes.
people were overlooking.
100%. But what really tipped over the consumer, right? Getting back to that signal, right? Getting back to that core existential thing that really drives market, which is the consumer, right? What really broke the consumer? It was the super cycle in oil. When oil basically spiked over $100, and that didn't happen until basically late third quarter, early fourth quarter of '07. Until that really happened, we didn't see anything in unemployment. We didn't see anything in continuing claims. Point in fact, continuing claims all through '07, while the canary in the coal mine of subprime mortgages,
Right.
we started first hearing the tremors of it in '06, right? So you're a year beyond that. And what do we look at from the consumer perspective? Consumer was still spending. Not only was it spending, but unemployment, I believe, in June or July of '07 was 4.4%, right? Not a
Right.
bad
Not a bad
situation. Continuing claims, I think, were averaging around 320, which, if you go back and look at the preceding 4 or 5 years, was right in line with kind of where everything was. And it wasn't until that third and fourth quarter of '07 where oil started to really spike up that you started to see real fracturing of the consumer, and specifically within like initial claims and unemployment.
So if we were to kind of drill down on that, because it's not as simple as just your gas is more expensive, you drive less, you do less, but it kind of permeates everything
Yes.
that the consumer uses. I mean, how much oil prices are going to get passed on throughout the system?
That's right. And I think that's what we're worried. That when I look
Well, that
at,
was the concern with tariffs, right? The tariffs are just going to get passed on. And we're not going to be able to absorb it.
Yeah.
So
yeah. But we look at what's going on now. So let's think about this polycrisis that we have going, right? We've got rumors of private credit and the shutters there. And then we've got the war going on in Iran and tensions in Venezuela continuing, in Cuba and all the rest of them, right? And then you've got the trade negotiations going on between the United States and the rest of the world and renegotiating all these trade parameters. And what was so interesting is when we first bombed Iran, the stock market was up that first Monday, right?
Right.
It wasn't down. Why was it up? War's good. War's good for the economy. War means more jobs. War means actually more industrial production. It's so demented, right, to kind of think that war is good. But I would argue that a lot of what we see in Europe, with Europe not wanting to resolve the Ukraine-Russia issue, has to do with if they weren't supporting and manufacturing more war goods there, their economy would flat out be in a recession, right? So they almost need the war. For us, it's just another positive. Okay, when does it actually start to fracture? When you start going after the oil infrastructure. Why? Because the oil prices go up, and what happens is now the consumer has to shift from fun and discretionary spending, right, holiday spending, to
necessity,
Yeah,
which is going to be more expensive. So it cuts. Where are you going to make cuts at? It's going to be in the discretionary.
yeah.
The fun money.
The fun money. And the fun money is like, when we think about it, fun money comes in so many different forms and fashions, right? 70% of our economy is services. What are services? Stuff that we no longer want to do, so we give it to someone else to do for us.
Right.
Right? The guy who mows our lawn, the people who work on our houses, all these different things, right? Those are the services, and you can only get to that once you've gotten past, how do I heat my house, how do I drive my car, and how do I feed myself, right? Sustenance. When those commodity prices for sustenance go up, I no longer have the discretionary for services.
Right. And that's fairly intuitive. So then the real question is, how long within these crises, obviously you want some to be shorter than others. So is it just a near-term blimp or near-term blip in the numbers, or is it sustained?
I think you need something that's more sustained for it to really knock. Like, we're at 4.2% unemployment. I think continuing claims just hit an all-time low this past week. So we're in a situation where the economy, the working economy, right, looks really good. And then you add to that the underlying fundamentals of the big, beautiful bill. And it doesn't matter if you like the bill or you like it from a policy perspective. There's two things that are really coming out of there. Number one is the tax withholding decreased by 2.5% for the average household. 2.5%.
Right, so that's essentially a raise across the board.
Yeah, everyone got a 2.5% pay raise from Uncle Sam in real terms.
So that should be good for discretionary spending.
And so you've got all these great positive things going on from a consumer perspective. Jobs are there, big, beautiful bill creating tax breaks, and then productivity, right? We're having a productivity boom again, right? We can call it AI related. We can call it, the big, beautiful bill, onshoring or helping to onshore more manufacturing and property, plant, and equipment, right? Which all leads to productivity. But all these dynamics are really, really positive. So the question then becomes, in this polycrisis of what's going on in Iran and what have you, is what is the only thing that can knock that out of bed? Is, I think, energy prices and food prices and sustenance pricing going back up to a level that starts to impact services spending.
Right. And to your point on the health of the consumer, I think it's interesting because I think we just hit a threshold on average home equity is at its highest amount ever.
Yeah.
So from that perspective, there's more equity in their homes. So by all measures, the consumer is in good shape.
Yeah. Yeah. Look at even like last year, we talked a lot about the jump in all different types of debt delinquency rates. Well, fast forward to where we are now, outside of student loans, card delinquency rates are actually starting to show a little bit of a downward bias. Housing delinquency are starting to show a little bit of a downward bias. Credit cards, pretty much, flatline.
Steady Eddie.
Steady Eddie. So like this stressed consumer, where's the stressed consumer? It's not. There isn't there. Like I said, the only thing that can kind of knock this out of bed is, in my mind, either the Fed starts pushing up interest rates at the same time that oil goes up like this, and that it stays there for some prolonged period of time.
Well, and that could be because you look at the relationship between Fed moves and interest rates and inflation, right? There's probably no closer relationship. So, and obviously energy ties to inflation as well. So that's where you could find yourself in that. Interesting. It actually is worth. You told me about a game you play. We'll call it. I think we'll call it Rich's 5.
Yeah, Rich's 5. Yeah.
So let's think about that. You do it every weekend.
We do it every weekend. Yeah.
You and your wife talk about. Let's start with dollar, energy, stocks, yields, and gold/silver.
Yeah.
So and news from the week and what it means for those markets, because I think this will be fun if we go through it.
Yeah, so let me tell you a little bit about how this whole thing started. So I was trading oil. This was 07, 08. And if you don't know, the futures markets open up on Sunday, every evening on Sunday at 6 o'clock. And from 6 o'clock, you start getting Asian futures tradings, essentially, right? So it's the first kind of look at how the market's going to open up into the week is 6 p.m. on Sunday. So Well, what do we usually do at 6 p.m. on Sunday? I've got 2 kids. I've got a wife, right? We usually cook dinner.
Yep.
Right? And my wife would just drive her nuts. Why do we have to go and look at the market? Can't you do that after dinner? Can't you do so instead of continuing to kind of go back and forth in a negative way about it, we started to turn it into a game. And the game was I started asking her questions, like very intuitively. All right. At the time, we only really focused on 4. We focused on what it's going to do for stocks, what it's going to do for bonds, what it was going to do for energy, because I was an energy trader at the time, and then what it was going to do for the dollar, right? And we would take, like what was going on in '08 and '09, obviously, so everything around the great financial crisis and the banks going and imploding on themselves. So right. It was a very draconian game to play, because you're watching the stock market go like this. You're watching oil that was once at 142 going like this, going downward. And we would just play this game. What do you think on the news? How would you play each one of these? And so fast forward to kind of where we are today in this Iran issue. So I'll give you a great illustration. 2 weeks ago when we first bombed Iran, we're sitting there, Sunday dinner, where markets are about to open up, and I said, all right, what are your thoughts? Where are we going to see stocks and bonds? That's where we always start. Those are the 2 most fundamental things, easy right. things. And she goes, well, I don't know. You've always said, war is good for the economy, so I would think that I would want stocks to go up. Sure, okay, let's play with that. And then she goes, well, when you get these risks, you get risks off. She's pretty smart, pretty intuitive. Interest rates go down. Okay? Well, with that interest rates coming down, what does that usually imply? The dollar is going to rally. Okay? And then what does it mean for oil? Well, obviously you're bombing
an
right?
oil producer.
Right?
Yep.
And now in the last few years, as we've added gold and silver to the portfolio, we talked about gold and silver, right? So she said gold and silver because the uncertainty have to go up. Well, market opens up. What happens? Stock market's up, but what isn't up? Yields. Yields go up. Yields should have gone down, right?
Right. So in tandem.
In tandem.
That's a move you wouldn't expect.
It's not a move.
And there has been a correlation lately.
Yeah. So on top of that, you then saw the dollar really rally. And so typically when the dollar rallies, we would expect interest rates to kind of go down, because where do they usually go? They want to go into bonds, government bonds. Something else was happening. So the question is when you play this game and the intuition doesn't match what the price is, now you have to dig in. That's where the money is truly made, is kind of where what you intuitively think is going to happen and the opposite happens, right? Is it already baked in? Okay, like in a lot of cases, a lot of price in market already gets baked in. It's the
right.
old, buy the rumor, sell the fact, thought. Well, who had that baked in? No one. So the question is, what else was going on there? I don't think anyone's gotten a really good answer for me, right? Is it they want to come to the dollar, but at the same time they don't want to go into bonds, which would be the safety? But they're not going into the stocks either at this point. So what are they going into? And I think that's the question.
Gold's pulled back since the Iran war.
Explain that one to me. Now, the gold one I can kind of understand, because we've seen, you had that ton of gold that was transported from Venezuela to the United States that they sold into the market. So how much of that is just that selling pressure? And then we saw some central banks across the East Asia that basically said, I'm going to sell a little bit to get hard dollar.
Right, and they've had such a run-up. I mean,
yeah, it was a good time to kind of do it for some of these people. So I think the question is God, what was Buffett's old quote? He used to say,
he said
the market. He said a lot. The market is a device for transferring money between the patient and the inpatient. Yeah, but first it buries you with so much noise you can't determine which one you are. I think the question is on like gold and silver, when it starts moving so dramatically against what you would think, do you just need to wait some patience here, right? And I think that run up that we saw when silver spiked into 120 and gold spiked to 5,600 is I think you've got some people who got it in at the top of the mania and are being washed out.
Right. That would make sense. But it is interesting that gold and silver each had such a run up when they're fundamentally different metals.
Yes.
And they're used for different purposes. And, silver will never be a gold per se. There's still an industrial use of silver.
60%. 60% of silver goes for industrial use. It's crazy.
Yeah.
Right. We never and that industrial utilization is going up. So I just don't for me, I think we're going to see gold and silver go back up. I just think there's a little bit of selling pressure from people who got into the mania and now are panicking, right?
Right.
And then I think there's some like we talked about just 2 seconds ago, the transfer of gold from Venezuela to the United States to sell into the markets. I think there's some of that central banks selling at the margins.
Right, and that would make sense.
Yeah.
Especially after the run up.
Yeah.
I mean, you're not going to see big moves. If we were 4 years ago gold prices and we attack Iran, we'd probably see a much different move in gold.
Absolutely. I think pretty much in any other circumstance you probably would have seen a much bigger difference. But the issue is like when the Fed starts raising interest rates again, that's typically bad for gold. So if the Fed is now going to start pivoting to more of a hawkish turn, which they seem to be doing, that could put gold and silver in a little bit of a channel here.
But that in and of itself is a wild card because we have the new chair coming in.
Well, let's see if he can actually get through a senatorial approval process, right?
So likely not the way our Senate's operating. But I mean, inflation's going to be the real. If inflation's hot, you don't want to be cutting rates while inflation's still elevated.
Yeah, I think the Fed's going to be in a really interesting scenario here, right? So what has the Fed always talked about from an oil price perspective? That oil is transitory, right? It's not part of really their core mandates. But let's face it, oil does it's insidious. It gets into all goods, right? So it does drive inflation.
There's that scene from Landman with Billy Bob Thornton where he's telling the lawyer everything she touches has oil in it.
Yeah.
From the clothes she wears to
Yeah.
just across the board.
Yeah.
It was great.
Yeah.
Great scene.
It is a great scene. So how are you looking at these markets? Like you're out there seeing clients on a regular basis. What are you hearing from them as a big important topic?
Last year the topic du jour was definitely equities and wanting more of them. Everyone was talking about international, but nobody was really sold on buying international.
Sure.
And we can talk about the reasons for why international outperformed, and a lot of it has to do with dollar. But what I was seeing across portfolios is an overall concentration in equities, and mostly S&P 500 type equities. So I think there's concentration involved in that. Now we're starting to see a rotation, so I think people are looking at maybe de-risking a little bit around the edges.
Yeah.
Maybe getting rid of some of their tech overweights, although the market's kind of ferreting that out a little bit as well. That's part of the rotation.
Yep.
So the main topic we've had lately is around private credit.
Yeah. Which is something that we deal with almost on a daily basis at Banker's Edge. And I think it's really interesting, right? Another noise to add to the Polycrisis.
100%. And you think about, every time there's widespread gating in portfolios, it really hurts that industry for a while.
Yeah.
And I get it. Clients want their money back right away, but I feel like every day we hear of another big firm that's having to gate their fund.
Yeah.
So I want to know, what does that, should everyone just put up gates and say, this is going to be your liquidity? This is what we're going to offer you, and get it over with? Because I feel like it makes it worse when it's just one after another.
Yeah, it's a great question. It's like the old statement of like when you buy another company, do you do 2 rounds of layoffs or do you do 1 round of really deep layoff?
One big layoff.
I would argue that it's much better for the psyche of the markets to just do 1 big layoff so that you can hire
Rip
back.
the Band-Aid off.
Yeah. And I think that's the same. The gating, the problem is, can they really talk to one another and say we should all do this in consortium together? I don't think you can, right? That would kind of rolling into some antitrust and oligarchy type rules, right? But I do think they need to The real issue is we've seen a greater democratization of private markets, right? All of a sudden, what used to be just the realm of the institutional has been democratized so much because now you have ETFs that basically give you proxy
Right.
access to private equity and private credit, right? And what is the first thing? Why has that never really been something that individuals have gone into? Because of the liquidity issues. So how did they try to solve some of those liquidity issues? By basically trying to give them, quarterly, access to their money, right? Something.
Right. We're going to let you redeem quarterly.
Yeah.
There's an asterisk at the end of that they don't tell you about. The small print.
The small print. Well, the problem is in private markets, you just can't just go and hit bids like you can in the stock market, right? If I want to sell Nvidia, if I want to sell Microsoft, I get on the screen and I just basically sell it, right? And unless I'm selling millions of dollars of shares, I can pretty much get access, immediate execution.
Do you think there's an education lack there with some of the investors? Because I would think the reality is if you were given liquidity, kind of carte blanche, the only way the manager could generate that liquidity is by selling assets. And so when everyone's running for the gates or running for the doors, you don't necessarily want to be selling assets at that point.
That's right. And typically, having been around situations like that in my career, you're typically not selling what you want to sell, right? The stuff that is really garbage, you end up having to sell.
Your best, most liquid.
Yes. So what ends up happening? You have portfolio degradation of quality.
Right. And then you're filled with the garbage, which compounds the problem.
Yep. And then you're left with like a Bear Stearns situation where they ended up selling off all their good assets, and we were just left with nuclear waste. It's
Right.
like, well, who wants this?
We work with one manager on a private debt fund that they have an interesting redemption structure.
Yeah.
So when you want to redeem, you're given a redemption share, which is just a vertical slice of the loan portfolio. So you won't get your money all at once, but at least you have that window as to when each position is coming due and when you'll be made whole on that position. You're still generating income. So if weighted average life is 29 months, call it 1 to 3 years before you're made whole. But part of it is the transparency of knowing exactly when the cash is going to come into the account.
Yeah.
So I think that's an interesting way to do it, and it alleviates the need for gates
Yeah.
and stopping investors from selling because it doesn't force the fund to do anything then.
Yeah, I think we need to go back to what is the fundamental investment there? It's an illiquid investment, right? That we believe has been underwritten properly. We got to get past the noise, right? Got to get past the noise.
And if it's been underwritten properly, you're getting rewarded for the illiquidity.
Correct. Which means I just have to kind of, it shouldn't be 100% of my book. It probably shouldn't be 50% of my book. It probably should be something like 25 to 20%. It's the money that I just kind of, it's there, but, I'm just going to let it do its thing. And I think as investors, if we're not communicating to them that is the expectation. I don't care what the gating structure is. I don't care that it says it has quarterly liquidity. We have to get in that mindset that we go into an illiquid asset, and while we might have some liquidity provisions on the periphery that we can utilize, we really need to think about this as an illiquid portion of my book that I really am just going to set it and forget it to an extent, right? Because most of these funds have end dates.
Right. Yeah,
Right?
termed.
It's termed. I guess the issue would be is if it's an evergreen structure, and we're seeing a lot more evergreen structures where you can't ever get out, right? Music is, I'm just put back onto the playground Ferris wheel, right? And I can't ever really get off. Now, in that particular case, yes, I need gatings, I need all these different things because how else am I going to get to the end of the term on this illiquid asset? So the interesting question from my perspective is in this gating issue, is will we see a pullback from some of the evergreen? Because evergreen has gone like this. Evergreen fund creation has really started to kind of take over in private credit and private equity land. And will this get them to go back down to kind of a fund life cycle to allow for real transparency on when that liquidity event is going to be for me?
That'll be interesting. I mean, it's always evolving.
Yeah.
When I think about, if I were a manager, I think launching a closed-end fund would be like the best thing you could do because it's just a perpetual vehicle.
Yeah.
And you have that management fee coming in every year, and there's a fixed number of shares.
Yeah.
People can do whatever they want with it on the market, but
that's what that's what they all that's the golden goose.
that's the dream, right? That's what everyone wants. Yeah.
But is that the right thing for the underlying investment as it relates to a client's portfolio? And I would argue that maybe that isn't a great structure.
Right. It's a great structure for the manager.
It's a great structure for the manager.
Yeah.
Yeah.
Just from a fee standpoint.
But I think a lot of this noise around private credit is really overdone. So let's pull back, right? Separating signal from noise. Okay, it's really noisy. AI is cannibalizing SaaS-based companies. Should these things be written down? That's the big headline, right? That's the big risk. But let's pull it back just one additional layer. Well, most private credit has specialties. Some specialize in SaaS-based businesses, some specialize in manufacturing-based businesses, and some of those manufacturing-based businesses, they don't do anything in asset-light businesses like SaaS at all.
Right.
So I think when we look at private credit, we need to make sure that we're not throwing the baby out with the bathwater, that we're really understanding fundamentally how their investment
Right, and
philosophy.
let's look at the issues there. So there's pressure on SaaS because of AI.
Yeah.
But some of the other companies are likely going to benefit. Their efficiency is going to go way up. So to your point, it's throwing the baby out with the bathwater.
That's right. That's right. So, and on top of it, why do we go into private credit? Because the yields are 11 and 12%, right, on most of these vehicles. Well, if I go into high yield public markets, right now, OAS, even with the spike up from Iran, is around 320. We put 320 on top of 360 for SOFR, and essentially we're call it 6.8%. Well, I'm getting 11 on private credit. I've got a 5%,
so another 5.
Another 5% buffer. Well, why do I get that buffer? That buffer is there for not only the liquidity premium, but because of higher default probabilities. But unlike high yield that is unsecured. So unsecured, what does unsecured mean? Secured means is you have assets. And then basically once you have borrowed against all your assets, now I can only borrow against my future cash flows, which is unsecured. Okay, so I don't have any.
Right, it's on credit. It's on your credit.
Yeah. So that's what high yield is. So in high yield public markets, that's all unsecured borrowing. Well, the recovery rate, because you don't have any assets there, when one of those companies goes into bankruptcy, you get about a 30% recovery rate. Well, let's go into private credit land. Private credit land, typically outside of
collateralized, you have
senior secured, right? Like you've got, even if they don't have assets, you're typically senior, so first
in line.
First in line. What is the recovery on senior loans? It's typically around 60 to 65%. So even if you're writing things down here, your recovery rate is way higher. So if you have 5% default, okay. Nothing in high yield in private credit is at 5%, but let's just say it's at 5% right now, and we take a 60% recovery rate. Well, of that 5% default level, I recover 3%, so my net default is 2%. Well, I'm making 11%, 11 on my yield, 11% minus that 2% adjusted loss rate still gives me a 9% adjusted yield,
which is still higher than the unsecured high yield portfolio.
Correct. So I think a lot of this thing we have to understand is the structure inherently beneficial and can maintain a higher default level? And I'll give you a great illustration from my own career. In 2010, I was hired by Munder Victory Capital to run the distressed mortgage strategy. So we were buying subprime loans that everyone else was selling. Everyone else was selling. So what did you hear?
You were probably dictating the price you were paying for them, too.
So at the time, our coverage from Goldman told us that we were one of 35 teams in the United States actually buying, right? Think about that. Of all the hundreds and thousands of investors, institutional investors out there, there's 35. The seller to buyer ratio was definitely tilted, right?
Right.
Well, we were buying a lot of that stuff at like 10, 15, 20 cents on the dollar. And what did we do?
They were happy to sell it to you at that too. They're like, look at these idiots.
Yes. Yeah. And so we would be in front of pension boards, and the pension board, because of all the turmoil in their portfolio, saw huge turnover at the pension board level because they were like, okay, the people at the board level just aren't doing it right. They usually even fired either their institutional consultant or their attorney. So now the whole board is new. They're looking at the portfolio. The portfolio is down 30, 40%, and they're going, man, we got to make some changes. And here comes, Munder and Victory Capital going, you know what, we think you should buy more of this. And they go, well, our attorneys said we need to get rid of this, and our institutional investment manager is telling you we should, and you're the only one saying we should buy. And we're like, yeah, let us show you how the underlying fundamentals actually look on this.
That's an institutional framework for the classic generic investor case of buy high, sell low.
That's right. That's right. So let me just put an exclamation point on this. So what happens? Well, subprime, this is one of the things that's often missed, right? Everyone's seen The Big Short, but until you've actually touched, felt, and understand how these subprime mortgages were structured, you don't actually understand they were made and structured to handle what? Subprime lenders, right? Subprime lenders borrowers have a higher default level. So the structure is inherently created to handle a higher default level. Not only was it created to handle a higher default level, but you had a higher interest rate as well. So that stuff that we were buying for 20 cents on the dollar, in some cases, we got 100% of our money back. On average, I believe it was like 89%-ish recovery on the 20 cents that we bought, right? It was an absolute home run. Created, double-digit returns for 6 years, equity-like returns for 6 years on that product.
Well, that's, not to go back to Warren Buffett's famous quotes, but that's the be greedy when others are fearful.
Yeah.
Fearful when others are greedy. So I think that plays right in there.
That's right. So one of the guys I was out with last night, where we were talking about 08, and we were like, well, why were we talking about 08? Because we're talking about private credit, and like, okay, should we be buying more private credit here? And the guy I worked with on that strategy goes, not quite yet. I haven't heard the pension funds, and I haven't heard some of the institutional investors starting to kind of pull the trigger. And he goes, that's the capitulation that we're looking for. He goes, right now, it's definitely starting to kind of flag some interest.
It's bubbling up.
It's bubbling up, but we haven't gotten the full pop yet.
Yeah. Well, I'm sure it's coming. And if you think about the private credit, though, the kind of arc we've been on, it started with a couple companies that went bust.
Yeah.
Mostly fraud. So
Brands and yeah.
But then it's the headline risk, and then it just kind of compounds on itself. And then somebody wants their money back, and they're told no, and then that's where you get the issues.
Yep. But until we see real institutional selling there, I think this is just a kind of a periphery item, right? Once you see someone like like a Yale Endowment or someone of that ilk go, hey, look, I want $1 billion back, not just like, a couple $1 million here.
Right.
You're not really forced to do a lot, right? Because private credit at 11%, you're getting 1% of that portfolio back pretty much every month in just income, right? So that can pay for a lot of that cash flow that you need to kind of send out to investors.
What do you think it does for the investor psyche? Obviously, there was a big push about expanding access to private assets. Mm-hmm. That's probably taken a pause for the time being.
Yeah, I mean, I think what we're seeing it from it on our side. So what do we do at Banker's Edge? At Banker's Edge, we help companies complete leverage buyouts by going into the private credit and private equity world to round out the capital stack, right? To finalize it. You buy a $100 million company, you've got $20 million in equity, you've got to come up with the other $80 million in debt and equity, and we go help raise that money, complete those transactions. Well, what are we seeing in real time here, right? Because this is the key. This is what you pay. This is why you get a capital market specialist like ourselves to help you do this. Is the leverage read to complete a transaction last year you could have probably gotten 3.5, 4 turns on some of these businesses in the lower middle market land in debt, which means I need to raise a lot less in equity.
Right.
What we've seen in real time is a leverage rate that used to be at 4 is now probably closer to 2.5 in private credit land. Now, how much of that is stress in the portfolio and money that they need to kind of pay to investors who are trying to get out? I would imagine that's a big component of it, right? A big component of it. And they need to, especially the big BDCs like Ares and Apollo and the like, who have to report their performance.
Right.
Well, what's a great way to report performance? Yeah, our credit underwriting has really improved. We've gone from 4 turns down to 2.5 turns of leverage, right? And now you've got a positive story. So I think what we're seeing in real time is the leverage read is really shrinking, right? You can't get as much leverage on a transaction that you could, 12, 18 months ago.
So then from a collateral standpoint, you just got to have more robust equity coming into the deal.
That's right. That's right. So now you're going to, which is more resilient, right? When you put more equity into a deal, you've got a more
resilient deal. Yep.
However, now the deal has to really pencil to make sure that the equity returns get. So you could get into a situation like we saw last year, where we saw a lot of failed deals. The first beginning of this year has been like off the charts from an M&A perspective, like funded transaction wise. The question will be, as we go forward into the quarters ahead, do we get back to some of these failed deals, just because now the equity check needs to be a lot larger than the debt you could have raised?
And I think a lot of that might play out if you, obviously in the Polycrisis, we see how those kind of shake out. Let's go through it really quick, because I think it'll be fun.
Yeah.
So let's go through the 5.
Yeah.
So over the last week, what did we see from the dollar?
Dollar has definitely rallied pretty significantly over the last 2 weeks from the beginning of this crisis. What have we seen? We've seen a little bit of stabilization in that. It's not as rallying as much. I think, which makes sense, right? Why does it make sense? You got to price in the risk off really early on in the trade, and now the question is unless the situation continues to devolve into a downward spiral, which it could, right?
It's possible.
We now have to look at, has the dollar run too much, right? So I think that's why we're seeing the dollar chop the last week. So that seems to make sense from my perspective.
Right, but it's holding steady. I mean, the rally is in there.
Yep.
And so that implies a risk-off environment.
Yes. Yep.
So let's go to energy.
Yeah. Well, energy. You've seen energy go from $70 to basically where we're at right now, basically hovering around $100. You got a $30 risk premium in there just for Iran. If you go out and you look at the futures curve, right, it's in what's called backwardation. What's backwardation? It's just a fancy way of saying that the curve's inverted. It's higher up front, right, because of the risk premiums. But once this war gets done, we have a glut of oil. Let's face it. We're oversupplied in oil if we don't have this Iran issue. And so where's the futures price for the end of 2026?
Lower.
Basically, $70. Right where we started this whole thing, right where it was. So
there's light at the end of the tunnel in that crisis, hopefully.
Hopefully, as long as we just I think the bombing of the gas field over the last couple of days, that's a real concern. That's a real ratcheting up, right? That is that. That's the spiral that we really, really need to be finding off-ramp for.
And so in that environment, we would think inflationary. So
it has to be.
So if we're going down the list, we are risk off with the dollar move, inflationary with the oil move.
Yep.
So let's go into stock market.
Yeah, stock market. Well, typically war is good, right? When did we? So initially, stock market goes up to 7,000 on the war. And now where are we at? We've really sold off quite substantially, but I think we're at 6,500-ish.
Yeah, that sounds about right.
Okay, so think about what that is. Basically, we've sold off around, call it 8-9% over the past week, right? What's going on there? Why did we spike up? Because war is good. What are we now trying to discount into the market? The fact that if oil goes up too high, we start to break the consumer. And that's the only risk that we have to the market. So the question can be, how do we get to the end of this as soon as possible, and how do we get back down to stable oil, at least an oil that doesn't continue above 100?
Right.
Right? That's the real key. Because if you think about it, right here, right now, gas prices in 2022, peaked out at around 490 on the national average. Right now, we're at 360.
Yeah, it's a big difference still.
It's still a big difference. We're good. And as long as I think we don't get back to those $5, that's when we started to see the destruction, right? And the real inflation, right? That's why the Fed had to get on the gas, right? From a rate hiking perspective in 23. It was really because gas prices got up to almost $5. And I think that's a real issue. That's painful. If it stays here, I think we're okay.
So this is where it gets interesting. Let's go into yields.
Yes.
So, because I think they behaved a little differently than one would expect.
Yeah. Basically, we are almost unchanged, aren't we? Started at around 420. We're right around 420 right now in the 10-year. You would have thought a risk off. We would have seen yields. I mean, they touched 390, but they've sold back off, right? We would have thought yields would be, I don't know, on a word like this, at least in the threes with a 3 handle on it. And we're at 420. So what's happening there? I think that's the bigger issue. That to me is the real bigger issue. Because if you're not risk offing from foreign countries coming into the United States into bonds, what are you really doing? Well, you're basically saying, I don't want to finance the U.S. government. I don't want to finance the U.S. government in this war, essentially, for all intents and purposes. Well, that has real knock-on effects, and we've already seen China really take out a big chunk of treasuries from their portfolio. I can't remember all the numbers, but it's almost like $200 billion less than what it was 3 years ago. Okay, from a treasury holding perspective, that's a big number.
200 billion.
Yeah. So the question becomes, in my mind, is if you get continued lack of treasury buying by international players on this, could we be in a situation where we really start ratcheting up yields here because the international community just doesn't support what we're doing globally?
And the knock-on effects of energy prices weighing into inflation.
Yes, that as well. So, that is definitely one. Right, because now you have to start considering that the Fed's got to get back on the rate hiking cycle to tamp down inflation. Right, all of those things kind of go into this equation.
Right, that's why I think it's a great game.
Yes,
it's a bit of a mental quagmire at times. I think when you're trying to piece it all together as you go through it.
For sure. And then gold and silver, the last one there. I that's the one on the board. That's the one thing on the board that just I don't understand right now.
Perplexing.
It is a little perplexing.
Right, but it was a historic move over the 2025.
That's right.
So was it too historic, to your point? Is there selling pressure from when you would expect in this environment specifically for gold to be stronger?
You would think. Yeah. Let's see.
Well, a lot to think about. I'm going to propose playing this game with Carrie every weekend. I'll let you know how it goes.
That's funny.
Well, I know we've taken a lot of your time, so I think I want to jump into just a couple of our last questions, Q&A, rapid fire. In your opinion, what is the market getting wrong right now?
Man, that is a great question. What is the market getting wrong right now? I think, like we said, I think the biggest one is I think the hullabaloo around private credit is much to do about nothing. I truly do believe that.
And that's not hard to see with just being blown out of proportion.
Just being blown, exactly. I mean, I think we're going to find that over the course of the next couple quarters here, especially from people like Ares who have a big chunk of SaaS in their business. Like, what is the real loss in there, right? Is the transition to AI much farther down the road, right, than we like to believe? Its impact on kind of prices and impact on credit is going to be. I think that's something. That's number one. I think the number two thing is I think this might be if you've been sitting on cash looking for an opportunity to get into a 4-year bull market, and you've been looking for a good reason and pullback, this might be your opportunity. Because I think as long as we don't have oil prices that stay sustained at a high level, which fractures the consumer discretionary, I think the underlying aspects of the consumer are as strong as we've seen. 4.2% unemployment, lowest levels on continuing claims that we've seen historically, real wage growth, productivity, like all these things that are at very, very high levels right now are all typically really good kind of barometers for the health of the consumer. And as long as this war doesn't drag on and oil prices don't continue to kind of process upwards here, I think this might be a great opportunity to be kind of putting and deploying some of that cash that you might be seeing.
And the reality is we've had an epic run in the equity market.
Yeah.
There really hasn't been much opportunity. I mean, we had the blip over Liberation Day last year. In hindsight, would have been a great time to enter the market.
Yeah. Yeah.
But there's really, outside of that, there hasn't been over the last 3 years. It's just been.
And how fast was the Liberation Day? It was like, bam, we fall, and bam, we go back up.
I mean, just a sharp V recovery. So as you think about the markets, what's one indicator you look at every morning?
You know, I think you need to get out of watching one indicator on. I say pull back, right? What do we talk about right today? Signal from noise. The markets, we have never been inundated with more information, right? Podcasts, news sources, everything, right?
More readily available at your fingertips.
At your fingertips. And more importantly, the Instagram and Facebook and all the rest of them are actually feeding it to you in your algorithm, right? So if all you do is look at finance stuff,
you're in your own echo chamber, and then it's just...
Yeah. I would say pull back from all that. I would say pull back from that. We don't need to be looking at signals on a daily basis. I think a weekly basis is about as much as you would want to do. Like in that, and I was a professional trader for 20 years, right? What's a professional trader? Someone who's in the market mixing it up on a daily basis, right? If I'm only really caring about kind of what the trends are on a weekly basis, for the average investor, mom and pop, look, pull up. You don't need it on a weekly basis. You don't need it on a monthly basis, right? I would argue the only number that you need to focus on, right? Getting back to the signal. What is the thing that propels the economy? It's the U.S. consumer.
U.S. consumer.
What is the key driver to U.S. consumption?
Well, it sounds like that's the global economy. It's all U.S. consumer.
Correct. So what is the only thing that really matters there? Jobs, right? So why do we see weekly claims? Why is the biggest number that the market trades around non-farm payrolls that comes out the first Friday of every month?
Yep.
Right? That is the only number that matters. The rest of it, in my mind, are just kind of other signals, right, that we need to pay attention to, we need to be aware of. But that's the big one. So if I'm going to pull up and look at one thing that I need to kind of focus in on, Mon Pa Kettle, and looking at my portfolio, what's happening right there, right? And then I like to think of things as being a street economist, right? Look around, open up your eyes, and then be aware. When the restaurants that I'm going into, are they busier today than they were yesterday? And then start tracking that in your head, because if you can see it with your own eyes, it becomes much more tangible in today's real aspect, and you might not get into the economic numbers for months down the line, right?
Right.
So really think about the dinner table topics, right? That right there is the truth, right? When you hear conversations with your family and friends where people are getting stressed, people are stressed, right? And that's real, right? And that needs to be kind of looked at. But we also need to look at, okay, I can feel stressed, but what am I seeing in the employment numbers? If it's not there, it's not something that's going to knock us out of the bed, that forces us to really reallocate and rechange our portfolios.
Oh, I think that's great perspective. I like the idea of just being observant.
Yeah.
Wherever you go, and you can kind of tell that would be a leading indicator.
It is.
Before that flows through to all the data, you're going to see that if you're paying attention, if you know what to look for.
Yeah, I think if you anyone who follows one of the Clintons' main political kind of analysts, a guy by the name of James Carville, right? What does he talk? It's always about kitchen table topics, right? That is at the end of the day kind of what drives, politics, drives the economy. What's happening around your table? You're already having the conversations, right? We don't need other numbers to confirm or deny what I already
what you're
feel.
seeing. Yeah.
Right. But we've been thrust into the situation of using Instagram and all the rest of these kind of reeling feeds to us that it's like, oh, don't believe your lying eyes, right? No. This is what we need. We need to have good awareness of our surroundings and understand how to interpret it into a broader scheme. That's where long-term kind of money and wealth is kind of created. It's how you identify opportunities. It's how you identify risks. It's how we identify everything. It's intuitive into our DNA structure.
Right, and I think it's compounded to your point with social media because as soon as you like something, it's going to give you like videos, and then it just keeps going. And so whatever your thought process is, it just puts you in that groupthink echo chamber.
That's right.
It's just reaffirming. I think I saw that most evident during the election.
Yeah.
Everyone was so sure their person was going to win.
That's right. Well, here's an interesting part, right? So we've never had more podcasts, more availability of news and opinion and punditry. But do we have more information? I would argue no. I would imagine the underlying signal or information, right? Not noise, not punditry, is probably about the same.
But I would say there's been the ability to access information is more widespread and more readily available.
So
it might be the same information, but I think everyday Joe being able to access the same information quickly is probably more prevalent.
So I would go on the other side of it, right? So why do I go on the other side of it? Because what are the key numbers that we really look at, right? They're published by the federal government. It's a 8-page report, 12-page report, 20-page report that comes out with non-farm payrolls and all the rest of the Bureau of Labor and Statistics data that comes out. It's published. It's always been there. All you have to do is kind of open up the computer, go to the Bureau of Labor Statistics, and literally, this is what we published today. It's front page, and you just kind of download it. The issue is we've gotten into not wanting to read and not wanting to go to source data. And so what ends up happening is we end up going to all these different news sources and podcasts and all these different kind of things, and we call that information. But really, the information is that underlying 8-pager. The rest of it is just
8-pager, and the rest is just the noise around it.
It's just the noise,
and it's all an interpretation of that.
Correct.
Rather than the actual data.
And a lot like
giant game of telephone.
It is, and I'll give you a great best illustration. I watch the president daily briefings. Okay, they're about whether it's the press secretary, that's about a 20-minute press pool every day, or if he gaggles right by himself, going out to the press, it's usually a 4 or 5 minutes before he gets on a plane or a helicopter, right? 4 or 5 minutes to get what they're going to talk about for 3 hours by every pundit out there. Why do I need 3 hours of punditry to break down what 4 minutes I didn't spend time watching myself? Right? So for me, I totally discount the news, and I don't care what side you're on, Fox News or MSN Now or whatever it's called. It matters not to me. I don't want someone else polluting my mind with their opinions. I want to go to the original kind of source material, and if it's I got to watch the president or Secretary Bessent talk at something for 20 minutes, that's 20 minutes that I get to hear from the source of news, right? What is going to lead the punditry to talk about for 3 hours, right? So I can actually save time by actually going up
to the source data. Well, that reminds me, I think I have it here. This guy just ruined news for everyone. If you ever read it, this is the best autobiography I've ever read.
So here's the funny. So I was just down in this past weekend. My daughter played her first outdoor tournament. Right, couldn't have been better weather. Right, 40 degrees and 32 mile per hour winds. Yeah. Why can't we do this one indoors, right? Anyways, so she had a school project that was due on Monday. So while we're down there, she's having to do the school project, and the school project is she has to do a 2.5 minute newscast. And So the teacher gives them a framework. Now she's a sixth grader, right? So
on current events.
on current events, and they give her, it's got to hit four things, right? You got to have a hook, you got to have a theme, you got to have is it a positive or negative article? So think about this. So using one fact, you've got to talk for 2.5 minutes. So what was her thing was actually it wasn't a current event. It was North Korea, South Korea playing a hockey game in the Olympics jointly in 2000, what was it, 18 or whatever it was. And she goes, I don't know how to write this. And I go, well, give her what she gave you the outline. Do you want to write a positive story or a negative story? That's the start, right? And she goes, well, I want to write a positive story. But she goes, but that hasn't led to them wanting to, like they still have the DMZ. They still haven't unified. I go, yes, but it's a positive story. What do we want to, what's the hook? What's the theme? And so we worked on this theme for about like probably 45 minutes, an hour, and we came to a message of hope, right? And so after we get done, and it's 4 paragraphs, and these 4 paragraphs get her that 2 minutes to talk about one thing, right? One fact. That's news, right? I spent 2.5 minutes telling you one fact that I could have given you in 15 seconds.
And you had to think about how you wanted to deliver the story.
A story.
Or the one fact.
Yeah.
What is that?
Because I've got to get you to listen. And if I just tell you that one fact, you're good. It's Jeopardy. You're not listening. Right?
I will say the one thing I found interesting when I read Andrew Ross Sorkin's 1929 is the overwhelming belief that the media has never not been biased. So we can talk about the 24-hour news network, but the reality is there has always been an agenda.
Yeah.
And every story you're being told, whether it was the newspapers, it always had an agenda behind it.
Yeah.
And there was an interesting part in the book where they were talking about they were in Cuba and they were worried about a war. This is before 1929, of course. And the publisher at the time, they write him back. They're like, nothing really going on here. He's like, well, I can give you the war. And he was just going to create it. So,
yeah. I mean, I think that's what we have to remember is a news story is a story, right? It's a story first because I want you to watch. I want you to listen. I want you to be online as much possible and watch as much of this content as possible. The only way I get there is by telling a story. Because if I just have to focus on the facts,
it's going to be very dry.
It's going to be very dry. You're going to tune out, and it's going to be a lot shorter.
Yeah.
So go upstream. Find the original source. Get rid of the news, or get rid of the story.
Well, you'll have a lot of free time. You won't have to watch the 4 hours. But do listen to a lot of podcasts.
Yeah,
you
exactly.
get a lot of different perspective.
That's right.
Well, Rich, great having you again.
Yeah, thanks, John. Or Jason.
If we could end it with, you promised us a hot take. We didn't really get it, so I'm disappointed there. But who did you pick to win it all, March Madness?
Dude, I am a Michigan guy through and through.
I figured you'd say that.
Yeah. So the question is can they do it now that their backup point guard Kason has gone out with an ACL? So who's my backup? Man, I think Michigan State looks really good.
Oh.
Yeah.
So you're not a Maize and Blue diehard.
I am, but I like that Michigan State team. I think with Duke having some of the injuries, I think Arizona looks good. Arizona looks really, really good. But that bracket on that side looks pretty darn brutal.
Oh, definitely.
Right? Brutal.
I did the tournament bracket the same way I did my fantasy football this year, and I had ChatGPT do the whole thing, game by game. I'm happy to report after yesterday's games, I am almost 100%. I missed one game.
Yeah. Did you get High Point, Wisconsin?
I did not get High Point. That's the only one I missed.
Oh, man.
ChatGPT had Wisconsin winning.
Yeah.
So, but every other upset.
Another 5-12.
No.
What is it about this? That the way they set up that bracket that is the biggest upset.
I don't want to be in the. Yeah, I don't want to be a 5.
No,
I mean, you're set up for failure.
I can lose a few games so I go down to 6.
These schools like High Point, though, I mean, how exciting is that for the school?
Yeah.
Never won a tournament game.
I don't even know where High Point is.
North Carolina. There was a Wall Street Journal article on it this year, too.
Okay.
So it's they're doing great branding, apparently.
There we go.
All right. Thanks, Rich. Great having you.
Yeah, awesome. Great as always.